Hello everyone, so this is our Q&A after our event with Jolt last week. So our Claro Make Your Money Work For You event last week with Jolt. We had quite a few questions come throughout the event from our attendees around the subjects that we were talking about. So we thought, as we couldn't cover off all of them during the hour, that we would answer them this week and share them on our Instagram. So today we've got Rachel here, our financial coach at Claro, to answer some of the questions. And so I'm going to kick off, Rachel, if that's okay.
Yeah.
So one of our questions was, what percentage of our income should we roughly invest or save every month?
So with this question, it is quite personal. So there's not necessarily a specific answer that I could give to that, but there are three ways I would say to look at it. You might want to think about what you're trying to achieve with the savings or the investments that you're making. So if you've got a goal in mind, for example, if you knew you needed £1,000 for a holiday next year, so maybe in 10 months time, then you need to save £100 per month to get there. So that could be one way of looking at it. So if you've got a target, a goal, something like that you want to achieve within a time scale, then you set the savings amount based on that. And also that helps with your goal, because you might then need to reassess that goal, or you might actually be able to achieve it sooner, or have to move out the timeline if necessary. So that's one way of thinking about how much to save. The other way is to have a look at what money's coming in and what money's going out, and see how much surplus you have, and then realistically how much of that can you save. So setting yourself just a realistic goal, and it is important that it is realistic and that it's achievable, because that will help motivate you to carry on and have that discipline and create that habit. Because if you're always setting yourself a goal that maybe each month you're always missing, so if you were going to save £200 a month, but actually you can really only realistically save 150 every month, you feel a little bit unmotivated. So setting yourself a realistic goal, and it's personal to you, and it allows you to get into a habit. So that's another good way of doing it. And then down the line, if you've got into that habit and that discipline, then when you need to increase your savings, then it might be a little bit easier. So that's the other way that you could do it. And then another way is percentage, which is obviously indicated in the question. So you can Google it and you can get some different schools of thoughts on what the percentage should or shouldn't be. Some people say between 10 and 30%, depending on what you look at, and that's fine if that method works for you and it's affordable. Then a percentage way of working out how much you should or shouldn't save could be the right option for you. So like I say, there are different options, and it's just picking which one's right for you. That means that you will actually save something every month and get into that habit and mindset.
Thank you, Rachel. Actually, that's made me think, because my role at Claro is to help create the content for the app, and we've got a whole content strand all around sorting and saving, which shares lots of different strategies and methods and tips from savers already that really build out on what you've said, Rachel. So the app and the sort and save content that we've got in the app is really helpful as well. That's a little plug from Claro. Thanks for that answer. That leads nicely into, I'm looking at the questions here, our second question. How can someone go about deciding on how, where and what to invest in? What to research in? What happens if you're not sure what platforms to invest in? What's your advice about that, Rachel?
So when you're thinking about where to save, where to invest, then if you're looking at platforms or product providers, then charges are a key starting point. And also with the charges, you need to think about how you are intending to invest. So for somebody who's wanting to maybe trade shares on a regular basis, then they need to consider what the charges on that platform are for that facility. Someone who wants to invest in an ETF or a collective investment fund, passive or active, whatever it may be, they need to be looking at the charges associated with that type of investing, because the same platform can have two charges for the different investment styles. But charges is a really good place to start, because they can eat into the returns that you're getting if you end up with a product or a provider where the charges are quite high. So look at the charges, look at, where are you at in your kind of investment journey, if it's investing, and how much information do you need, like education. So some platforms provide a lot more help to assist you in making your decisions. Educate you on the different types of investments and what you're picking. So if you need a platform that does that, then make sure you obviously look to see that it's able to provide that. And then, convenience and ease of use, that's obviously a huge one, because when you're getting started in this kind of environment, you want to make it as easy as possible. So picking something that's got the good functionality and allows you to use it well. And then, service, which, there's reviews for lots of different providers, and picking one that provides good service. So those are all like key things to take into account when you're looking at different platforms. And charges is generally the biggest one that people consider, but I think the other factors should play a role as well in when you're picking a platform. And then in terms of like investments and funds, there are also so when you're looking at the funds, you can do a lot of research on them and what they're investing in, take into account levels of risk. And independent agencies do rate funds. So, you can look at that to kind of give you a gauge of how that fund's performing, or if it's managed by someone, how that fund manager's doing. So there's like Citywire and Morningstar, all of these different independent agencies that can rate them. So, you can have a look at that to gauge on what type of investments you want to be looking at and the performance. But with all of these things relating to funds, they're not guaranteed to continue into the future. So, you can have a look at those, but review them, because, performance and past performance isn't a guide to what's going to happen down the line. So you need to make sure that you're wary of that.
Thanks for that answer. That's just made me think, when I've been looking at things, I've seen different types of rating. I think like one rating, I'm sure I've seen said something like AAA rating and things like that. Is that the rating that you're talking about?
So yeah, like Citywire does, like AAA ratings and things like that for the fund managers. But then also for investments, for like bonds, then they are rated by credit agencies as well. So the bond issuer has its own credit rating, because one of the risks with bonds is that the issuer defaults. So they're rated as well to see, if they're a AAA rated, then obviously they may be a more safer investment than one that's BBB or something like that. So you may see rating for bond funds like that as well.
Yeah, and I'm assuming, again, you can Google the rating standards like AAA, B, etc., so you know what's good and what's not so good.
Yeah. And if it's for investments, then a lot of the time they're on the literature, so on the fact sheet, or if you're on an app or something, then they might have that shown. Because obviously, if they get a good rating, then it's a good thing to show, isn't it? On your literature is a bit of a selling point, I suppose. So it's normally displayed.
Yeah, and on those fact sheets, the literature sheets that you get, are they now starting to show things like the ESG scoring, so the ethical, the environmental impact of the score of the fund or something like that? Was that something? Would you find that somewhere differently?
Yeah. I mean, if the funds have that, then normally they do display that in some way on their literature and their fact sheet, because again, that's something that's key to their process, their philosophy, and that's what that information is there for. So they would display that kind of information there as well.
Great, thank you. That's really helpful. I've got the next question here as well. So this leads into what you've already been saying, actually. So this was a specific question around bonds ETFs. So key considerations, what's the key considerations of investing into a bonds ETF or a collective investment fund or bonds directly? So what can you share about those type of decisions?
So one of the key things is if you invest in a bond or like a share really directly, then your exposure, so your returns, your risk is all related to that one company, the credit issuer, or the company that you've got the share in. Whereas with ETFs and collective investments, effectively, you're pooling your money with other investors, and it means that you can access a more diverse spread of companies. So you pull all your money together, and then you're exposed to a portfolio that has a number of different companies in there, or a number of different bond issuers. So it reduces, hopefully, the risk and the volatility. So if something happened to one company, if that company defaulted on the bond, or obviously if something happened to that company and it failed, it wouldn't impact the full return, of your money, because you've got other investments in there, in the collective investments in the ETFs that would hold it up. So it wouldn't mean losing your money. Whereas if you're only exposed to, if you're only investing directly, then you're at the mercy of that one company to perform in order to generate the returns. So it's like they're not putting all your eggs in one basket type argument, and diversification is really like the key way that you manage the risk, and you can get that exposure with the collective investments. And also, it depends how active you want to be really in terms of being an investor, because if you put your money in collective investments, then you don't have to be looking on a daily basis. Not that you necessarily do if you're investing in direct investments, but you definitely need to keep more of an eye on it if you're looking to trade all the time, or have those types of investments. So that's another thing to consider when you're picking which investment style to go down the route of.
Yeah, and I think that really showed in our event last week with Jolt that we have 3 very different portfolios and 3 different types of savers and investors with different levels of time. So with 2 of our savers and investors, they spent between 1 and 2 to 3 hours a month on their portfolio, sometimes less than 1 hour. And I saw in their portfolios that they did have ETFs and things like that, stocks and shares ISAs and things like that. Yeah. Whereas in our 3rd portfolio, they spent 60 hours a month on their portfolio and picked individual stocks and shares. So they were dedicating that time, that checking the volatility of the market, I assume, like what's up and down, reading all the newspapers, Financial Times, all the charts you see. So they were probably taking a more calculated risk because they had the time to check on it, whereas in the other investors were able to spread and reduce the risk by choosing an ETF, for example.
Exactly.
Yeah. Okay, that's really helpful in explaining that to me and to our audience. I think there were some other questions about what are good resources to learn more about ETFs to invest in. We've got our own resources at Claro that we create, and we create those with people like Rachel and our investment manager Galina, who was at our event last week as well, so that we know that we are creating very good, sound resources based on industry expertise, but we also try and create those resources to be in plain English because there's a lot of jargon. So those resources are available. We share them on our social media platforms. You can download them. We'll share them when we release this Q&A. But what other resources would you recommend, Rachel, for our audience to go to search for information? Or what considerations would you ask them to take into account if they're looking for information?
There's loads of information out there, isn't there? Obviously, Google, you put in the words and there's 50 million pages that come up for every topic. So just be mindful of the information that you're reading. Make sure it's trusted sources. There's a lot of really good government websites which are obviously unbiased, impartial, and don't have any reason to veer you down any avenue. So that's it's good to access that kind of information. So you just have to make sure it's from trusted sources, and obviously that can come a lot from recommendations, I suppose, and there's great podcasts and stuff out there. So make sure that, I suppose, if you are listening to those kinds of things, you know, who's behind it. Are the people qualified to be providing this information? It might be interesting, but just take it for, I suppose, the level that it's at. So make sure you do your research really on who you are listening to and who you are reading, which blogs and which websites you're referring to for the information and the education. And obviously our resources will be great.
Yeah, and actually one bit of advice somebody gave me, but not until it was slightly too late, was check the market that your resource or your website is for, because I spent hours using a website that was really good, but it was for the American market. So the problem with that was it was talking about tax implications and products that weren't even available to me, that I couldn't access and I couldn't use, and I spent hours. So the biggest bit of advice someone gave me was make sure that your source is for a British market if you're in the UK.
Very good point.
And that's the same with apps actually, because there's some really great apps available on the market, and I made this mistake as well. I downloaded an app that was for the US market and then couldn't use it here, because there's different rules and regulations, definitely from a compliance perspective, that means as a British citizen you can't use that app, or it's not relevant to you. So again, like for example, our app is for the British market. So you're going to have products that you can buy, and you're going to have advice, and you're going to have resources that are suitable for you. But I suppose that's also for some of our audiences that's not in the UK, to be mindful that when we do talk about tax brackets and things, especially around ISAs, that they may not be applicable for them. Is that true, Rachel?
Yeah, I mean, ISAs are for UK residents. So yeah, you have to be careful of that. And actually that's a really good point. So when you're picking your products and your platforms and and your investments, the other layer is like, which product are you actually going to put these investments in? So is it going to be an ISA? Is it going to be a general investment account, pension, whatever that may be? So, and tax is a huge thing to take into account when you're looking at that.
Yeah, thank you. So yes, that's all the questions that we have. We've wrapped them up into kind of some 3 core areas, but as we said, we've got a great deal of resources that are accessible, ebooks and PDFs. We've got a risk survey to help you figure out what your risk levels are, your risk appetites when you're making decisions about your money, and other resources as well that you can access from us. We'll make these available when we release this Q&A response, and you can also get them by connecting with us on our Instagram and Twitter accounts as well.